The S&P 500 just formed a pattern that's predicted major moves 3 times in the last 12 months. And it's happening again right now. Here's what you need to see. The market dropped 2% last week. Nasdaq fell over 3%. Everyone's panicking about AI valuations. But the chart is showing something completely different. Look at this. The S&P is testing 6,700 support right after bouncing from 6,640. That's a classic double bottom formation that's appeared at every major turning point this year. March, double bottom at 5,900. What happened next? 23% rally through June. August, double bottom at 6,200 during the AI sell-off panic. What happened? 15% surge to new highs. Now, double bottom forming at 6,640. And here's the kicker. Volume on the bounce was 20% higher than volume on the sell-off. That's institutional money stepping in, not retail panic. The RSI just hit 32 during last week's drop. That's oversold territory. It's only hit that level 4 times this year. Every single time, the market rallied at least 10% within 6 weeks. But there's more. The Magnificent 7 stocks make up 40% of the S&P, and they're not breaking down. Alphabet just rallied 6% on AI news. Broadcom surged 10%. The leadership is holding. Here's what the pattern is telling us happens next. Scenario 1. We retest 6640 support one more time this week. If it holds with strong volume, we launch to 7100 by year end. That's a 6% rally from here. Scenario 2. We chop between 6600 and 6800 through Thanksgiving week as volume dries up. Then breakout after December Fed meeting. This is the most likely. Scenario 3. We break 6640 on heavy volume. That triggers algorithmic selling, and we drop to 6400 before finding real support. Only happens if Fed signals no more cuts. The technicals point to Scenario 2. Here's why. November is historically one of the best months for stocks. Over 20 years of data shows November averages gains in 71% of years. We're already past mid-month and only down 2%. That's actually setting up the year-end rally. Plus, there's over $20 trillion in cash sitting on the sidelines. Interest rates are still dropping. Corporate buybacks are at record highs. And 401k flows are pumping $6,000 per person into index funds every year. The structure of the market has changed. ETF inflows passed $1 trillion this year. They have to stay fully invested. That's constant buying pressure under this market. So when you see a 2% dip on AI bubble fears, the chart is screaming this is the dip to buy, not the top to sell. Here's what I'm watching this week. Monday. Can we hold 6,700? If yes, that confirms the double bottom. Wednesday. Any Fed speakers hinting at December rate cut? That's rocket fuel. Friday. Shortened trading day, but watch the close. If we close above 6750, the pattern is confirmed and we rally into December. The chart doesn't lie. 3 times this pattern appeared. 3 times it led to double-digit rallies. It's forming again right now. Are you buying the dip or selling the fear? Comment 1 if you're loading up. Comment 2 if you think this breaks lower. Comment 3 if you're just holding and watching. Because right now, this chart pattern is giving you the roadmap. The question is whether you're reading it correctly. Follow for daily technical analysis. I break down the chart's Wall Street watches at 7 a.m., 1 p.m., and 7 p.m. every single day.